there was still terrible news coming out. There was layoffs by the hundreds of thousands in a matter of 6 weeks. That's terrible economic data, and it continued like that for a while. Well, the market turned around and
it went straight up.
On a rocket ship since then. As the stock market was looking forward and say, okay,
right,
this is a virus. If we can get past this, what does the future look like? Welcome to P&L, Priorities and Lifestyle, with your host, Rob Schultz. Rob is the founder and president of Schultz Wealth. All opinions expressed by Rob and his guests are solely their own opinions and do not reflect the opinion of Schultz Wealth Limited. This podcast is for informational purposes only and should not be relied upon for investment decisions. Please refer to our website for more information.
Hello everybody and welcome to P&L, Priorities and Lifestyle. I am your host, Rob Schultz, and today I have Austin Smith. Some of you may know Austin. He's been on before, and we work every day of the week together, don't we?
We do.
You get tired of me sometimes, don't you? Yeah.
Oh, never. Oh, never.
Never? Okay. All right. But this go around, we are just kind of talking shop a little bit, which should be fun. We're going to talk a little bit about just kind of what's going on our desktop as far as the different kinds of investing opportunities that we're seeing. Talk about the planning as well that's going on here at the end of the year with our clients and some of the things that we need to be thinking about going forward into the next few years. Planning and investing, that is what we do.
All day long.
Yeah.
All day long.
Austin, real quick, just kind of, if people don't know who you are, why don't you just real quick, just give us an idea, give us some of your background on, give us your story a little bit.
Yeah, Austin Smith. I joined Schultz Wealth in 2018. I joined Rob pretty much right after I graduated school. I was looking to get in somewhere where I could work with people and, kind of apply some of the financial knowledge and background. Really wasn't sure what that quite meant at the time, but very fortunate kind of the shape it's taken the last 5 years or so. Now I certainly spend most of my time looking at numbers, heavy on the investing side of things, but really heavy into the planning side of things too now. Certainly as things have gotten more sophisticated, a little more complex, working inside of heavily with estate planning attorneys, setting up structure for clients that is complex on the front end, but is very accretive to long-term benefits down the road. With estate structure, pulling stuff out of estates, making sure that everything is structured correctly. It's been a lot of a learning curve, the last year and a half that we've gone deep in here, but it's been super cool.
Yeah, it has. I mean, so we have had we've had a great year, and we've been doing quite a bit of estate planning work. So let's talk about that a little bit. I mean, obviously, my whole career, estate planning is part of financial planning, but man, it just feels like this year we kind of took it to a different level from the standpoint of working with some business owners, either that have transitioned their businesses or are looking at a liquidity event, and kind of some of the stuff that needs to happen, when that occurs. And that's what we've been doing a lot of this year, hasn't it been?
Right. So we've been fortunate to work with a lot of people who have taxable estates. There's some really exciting situations we've gotten to work through, but they also require a lot of complex solutions. And that's, setting up family limited partnerships, accelerating gifting, up to the taxable limits, because, hey, we may have a transaction on the horizon. So if I pull this out of my estate and put it in a family limited partnership and gift some of those shares to the next generation, I have the ability to see the growth of after the transaction. The growth in value happens outside of a taxable estate situation. And so very valuable, some of the extremely beneficial stuff we've been working on has been in that path. It's been really exciting.
Yeah, it has. And so, those of y'all listening, that's why we try so hard here to get in front of a transaction. Like if there's going to be a liquidity event with one of our clients, we want to start working, in some cases, a few years before that. Certainly, at least, it'd be great if it's a year to give us time to be able to get an independent valuation on the business and on the estate, so that then we can apply some discounts, and in most cases, in many cases, push the shares of a closely held business into a family limited partnership or a trust, so that when the transaction happens, it's already out of your estate. You don't have to pay estate taxes from a legacy standpoint. It's a big deal, and it takes a lot of work.
Absolutely. And the other big part of it is trying to you want to get it done ahead of time. You know, it's you can always think, oh, I'm 5 to 6 years away from that. I'll worry about it in 3 to 4 years.
Yeah.
Well, that's not a great plan either, because the way the current tax code is written, if there's no legislative action done by Congress by 2025, the current estate exemption is going to pretty much be cut in half.
Yeah.
And so we've had a lot of activity around being able to accelerate some of the gifting to take advantage of the higher exemptions right now. And that's something that's extremely prudent, because you know, there could be an act of Congress to change it before then, which now is probably less likely to happen than we might have thought a year ago, winding down to last year. But regardless, we've never had estate levels this high, and banking on Congress to do something to make a change is probably not. It might happen, but if I was a betting person, I would be on the other side of that bet.
Yeah, I don't think so either. So the exemption's gotten up to, I think for next year it's 12.92 million per person, which is way up there. But there are strategies that we're using to just try to capture that now, kind of where it's at, in case it goes down, or obviously as these estates grow. So we're able to do that kind of.
The other thing is, if you have a company and you think, oh, well, I'm still in 5 or 6 years out. Mm-hmm. Well, that's 5 or 6 years of growth, hopefully, as you as a business owner. And the earlier you're able to get it out of your estate, you can get all the growth out of your estate as well. And you generally, full autonomy, decision making. You're not passing over the reins to anybody by any stretch of the imagination.
Yeah.
With some of this structure, you're just probably working in a little bit of a more efficient mode.
Yeah, and it's just different. It's certainly different. Well, cool. So, we've been doing a lot of estate type work here recently. A little bit of end of year tax planning as well. This has been a tough year in the market.
Certainly.
One of the things that, as a financial advisors, that we're always thinking of in down years are taxes and ways that we can, kind of create some losses. Talk about kind of how we do that.
Yeah, so it's called tax loss harvesting. So essentially, the market goes down. I mean, all of our clients are exposed to the market on some degree. And so we say, okay, how do we maybe take advantage of the situation? And certainly one strategy is tax loss harvesting. And that's, in simple terms, you buy stock A at $100. It goes down to $80. Well, you lost $20 on your statement. You haven't realized it yet. You didn't sell anything yet. But if we go ahead and we sell at 80, we realized a $20 loss. And then we said, okay, well, we still want to be invested in the market. We're not just cashing out. Mm-hmm. So we buy a stock very similar to A, stock B, and we're buying it at $80 a share. And hopefully, the market recovers and we go back to $100 a share. And so really, we started at 100, we ended at 100. But we also were able to pick up $20 of realized tax loss to go against, income and other areas.
Yeah, and that's especially important if you have mutual funds within your portfolio, because you may not realize it or not, but even if the value of that mutual fund goes down, there's still been trading within that fund, and if there were any gains, any capital gains within that always flows through. So they push that out to you. So you could be down on a mutual fund, you could be down 20%, and yet still have some taxes on that, which is never fun. So we're always trying to do this tax loss harvesting, kind of offset that and other things. That's been a big part of what we've been doing the last all year, and then just kind of talking about it and looking at where our clients are ending up here towards the end of the year which is wrapping up here pretty soon.
Yep, and we've had quite a few meetings with accountants here recently, and some of the accountants are, really surprised because over the years we've transitioned, some accounts, taxable accounts where it made sense from traditional mutual funds to exchange traded funds, ETFs, commonly called, and been watching through how mutual funds and ETFs that are kind of invested similarly, but the mutual funds have the flow-through income where the ETFs don't quite the same way.
Right.
And we've been working with accountants and saying, hey, this account traditionally had probably some mutual fund flow-through income. We were able to switch that to an ETF advantageously with taxes. And now we're really not expecting hardly anything. And that's just speaks to the point of how efficient ETFs and taxable brokerage accounts have gotten as they've
just advanced.
As technology has advanced, and these companies have been able to do things more innovatively. It's been really cool talking with accountants. They're like, wow, we were able to really keep the tax amount down here, even on large accounts.
Yeah, and I think that's going to become especially true. We talked about, definitely the estate tax, kind of getting cut in half here in a few years. Well, at the end of 2025, the current tax laws sunset in essence, which means that we kind of expect all of our clients to be paying higher taxes.
The bracket's going to go back to where they were in 2016.
Yeah. And so a lot of folks, defer. Remember, so when you defer your taxes, you're doing that usually through an IRA or what we call a qualified account or a 401k or whatever it may be. And, one of the assumptions that you always kind of make when you defer your taxes is that your tax rate will be lower when you start pulling it out. And we have a lot of really successful clients that their tax rate is not going down, it's going up.
Right.
And so being able to build out just these, what we call non-qualified accounts or just a general securities account where it's really efficient from a tax standpoint has been huge. I mean, it's really helped because, first of all, there are no strings attached to that account. So you don't have penalties or anything if you try to get to it before age 59 and a half. A lot of the advantages we talked about, the efficiencies that have occurred. But then another advancement that's happened is like in RIA shops like ours, just the software that we use to trade is so much more advanced than it used to be. Or when we're trading and stuff, the computer helps us find the different places when we do have to trade to generate cash to be very efficient. It's really, really advantageous.
Right. Certainly makes my life sometimes a lot easier when I'm going through there and trying to raise cash, but looking to do so in a tax efficient manner. Certainly there's been a lot of advances there as well.
Yeah, it's been really good. So as far as sitting at your screen these days, Austin, you do a wide majority of the trading currently for the firm. I would say, I'm thinking like even in the last 3 or 4 weeks, things have really changed with regard to some opportunities. Tell us kind of what you're seeing and what you're doing right now.
Well, oddly enough, so Rob knows this. I've been anti-interested in bonds at all in the last probably too long.
You bought some bonds today.
I bought bonds today. We were able to find
Hallelujah.
Right. We were able to find corporates that were paying north of 5%, high level, high quality, which is all we ever look at on the fixed income side. Nothing extended, no high yield, anything like that. But very solid companies paying north of 5%, which I don't think I've seen since I started here.
No, you haven't.
And that's finally getting to a level where, okay, I can accept 5% on some of this commercial.
On the safe money.
Right, on the safe side. And that's actually been really interesting because it's not been that way. And it's provided us the opportunity to, when we think of investments, and we've talked about this a lot, in the shop here recently, is looking at it in 4 quadrants, from safe money being fixed income money, and fixed income can come in the way of bonds, which we bought some today, structured notes paying income, or other alternative types that pay fixed income as well. And then there's an alternatives bucket, and then there's the equity bucket, And then there's kind of the protected equity bucket. The protected equity bucket is what's really looking attractive to me right now.
Yeah, and that's we call it the buffer. It's an options backed strategy that's inside of an ETF, and that sounds really technical and scary, I know, but it's something. It's we have been in this part of the market for quite a few years at this point, and it's a really important part of what we do to protect our clients, and that pricing has been fantastic.
Right. I mean, we're talking about we can take, on the S&P, for example, we're looking at, north of 20% over a 1-year basis where we've got 10% protection to the downside. I mean, and so I guess if you think the market's really going to explode the next year, then you want pure market exposure. But otherwise, I'll take 20% in a protected strategy all day long.
Yeah.
And even we've seen on the downside, this year has obviously been challenging in the market, but we've seen how much this has helped the portfolios on the downside where, we're invested in the market, but we've got 10 to 15 and 20% downside protection.
On certain portions of it.
Yeah, on certain portions of the portfolio, exactly right. That's that buffered strategy, the protected equity part. Where traditionally you look at the fixed income as the safest part of the portfolio. Mm-hmm. Our buffer strategy has outperformed that this year in a lot of places, and it's
because rates have come up.
Absolutely.
Yeah. No, it's been good, and we've been doing a decent amount of trading here recently, and I've felt pretty comfortable about it. So from that standpoint, let's just talk from a macroeconomic standpoint, kind of what's going on. I've been saying this is that everything seems to make sense to me domestically. Okay, that what's happening in the market just kind of makes sense based upon inflation, unemployment, rates, what the Fed action. All these are pretty basic levers within. Do you say levers or levers?
I'm a levers.
Yeah, my wife gets on my case about that. I call them levers, and she thinks that's pretty silly.
Levers?
It probably is. It's levers. Levers. I can't even say that. But you have all these, and it just, you pull these different levers. So yeah,
There you go.
Okay, and they do different things within the economy, and that seems to have made a lot of sense to me. But what doesn't make sense to a lot of people is how, like, for instance, right now, and I know this is coming out later, but market was down a lot yesterday. It's been down a decent amount today. And it's been because there's been really good economic data coming out. And people go, what? Why is the market down? Because there's like really solid economic data coming out.
Yeah, it's exactly right. So that's why when you say kind of understanding what's going on and making sense of it, I certainly can walk myself through the understanding. But for someone who just picks up the Wall Street Journal article today, it says, hey, 200,000 new jobs last month, wage growth increasing by over 5%. Sounds like we're killing it, clicking on all cylinders. And then, the Dow's down 500 points or whatever. Yeah, you would think that's opposite. You'd say, hey, the economy's some really strong economic data comes out and the stock market's down. Why is that? And like we've said, a lot of the pain throughout the year, certainly in the fixed income market, has been interest rates. And when the strong economic data continues to come out, that just kind of indicates that there's probably going to be further interest rate hikes into the future. And that's been the pain from the stock market of, higher expected interest rate costs, which is, cost of capital, so makes it more challenging for these companies to, interest expense and otherwise, to do projects, makes it more expensive, while it also decreases the value of future cash flows when evaluating, equity positions.
Yeah, and it's that future cash flows that's what the price of a stock represents. And I'm going to steal your line. You said it earlier, but I'm going to steal it. That the economy and the stock market are two different things. It's easy to think that, if the economy is hitting on all cylinders and everything looks good economically, that we should be in a bull market, and vice versa. And a lot of times that is the case. But they are different and distinct, and they have their own independent cycles to a certain extent.
Right. I would say they're most distinct at points of inflection.
Right.
So the most glaring was during COVID. I mean, the market bottomed on March 23rd, 2020. Free fell to that point. There was still terrible news coming out. There was layoffs by the hundreds of thousands. I mean, I think we got to like, I don't know, so maybe 14 million unemployed.
Yeah.
In a matter of 6 weeks. That's terrible economic data. And it continued like that for a while. Well, the market turned around and
It went straight
got
up.
on a rocket ship since then. So that was like some obvious decoupling of the stock market, because the stock market was looking forward and say, okay,
Right.
this is a virus. If we can get past this, what does the future look like? We were killing it beforehand. Let's get back to killing it, essentially. And right now, it's kind of another point of inflection. It's always interesting to read financial pundit and people's opinions on recession or not, or what's going to happen next 18 months or not. I kind of think that there's probably going to, I mean, it seems like there has to be some worse economic data to come out. That's what the Fed is trying to do with raising inflation, or raising the interest rates to curb inflation, to slow down the economy. Like, that's the goal right now. But if you take a step back and say, well, the market was, fell, I don't know, the bottom was 22, 23% domestically here this year. Based on what? Well, based on what may happen in the future. So could we get to a point where some of that economic data does start to get bad in the next year, 18 months, recession type economically, but the stock market does good again? Because the stock market already priced all of that stuff in this year when the data wasn't actually bad? So I think it's always interesting when people talk about, the sky is falling, recession in the future. The stock market may not have already priced that into consideration for this year on a forward-looking basis. So there's certainly two different things, and they interrelate a lot. But that doesn't necessarily mean that economic data, good or bad, is going to, in the short run, affect the stock market, good or bad. Over the long run, it's pretty correlated.
Yeah, and when we're trading, I mean, right now is a really good time because, I mean, if we look at equities, pretty decent valuations there. If we look at fixed income, it's come up, as we've said. It's been low forever.
All I've ever seen.
Yeah, and now in good solid fixed income rates is really important to a long-term portfolio.
And you see a lot of stuff in the news going on, like the FTX blow up, other bankruptcy type stuff. When money is essentially free, when the cost of capital goes to zero because interest rates are so low, that's when you really see some of these bubbles come up.
Yeah.
Because these companies can get started. There's no hurdle rate for them to have to be successful to pay back money, essentially, at an early on, because rates are so low. So increasing the hurdle to some level is probably good and healthy long term.
Oh, there's no question. It's healthy all the way across, not only from that standpoint, but on an investor standpoint as well. You had to bring up FTX.
That's one of the blow-ups. I guess there's other crypto-related blow-ups. But
that blew up my podcast.
Now they get to hear me today.
Yeah. Okay, so I'll admit it. So Austin had to step in because we did this big podcast on crypto, about a few weeks ago?
I think 2 weeks probably before the blow-up.
Yeah, just like right before, and then FTX hits the fan, and I'm like, dang it. I can't do this, and it was a really good podcast.
And the guy who's on is super knowledgeable, extremely cool story, and he'll be back to explain.
Yeah, he will.
We wanted to be able to talk through some of the blow up that happened as well, with his perspective and his knowledge.
Oh yeah, and we will do that.
It's coming back. It's just we wanted to make sure we hit it right.
Yeah, and it's and it is a big deal. It's probably most of us are very insulated from what happened in the crypto world here recently, unless you were a big crypto investor. It probably didn't really affect you because the contagion was kind of within that industry. But this was a really big deal.
A lot of money. I mean, yes, it was certainly very concentrated inside the crypto world. At least it certainly looks like it so far. A lot of money, though.
Yeah. Just evaporated.
And it really goes to the need of regulation in the industry. Because really, I think we've had this conversation. Really, it's similar to some run on the banks back in the late 1800s.
1837 bank panic.
Maybe early
you know?
1800s. But, you know, ultimately, banks are similar today. If everyone went to the bank at the exact same time to pull out their money, the money wouldn't be there.
Right.
There's assurances, and you know, the government, FDIC, have assurances to make sure you can be made whole to a certain level. But that's how banks make money. They lend that money out. There's none of that. There's no safe backstop in the crypto world. Well, there wasn't. I'm sure there will be. Some companies are going to try to figure out how to do it on the other side of this because it's not going away.
No, that's a good point. It's not going away. This really is a viable technology that is going to touch all of us at some point. And in a way, I'm kind of glad that this happened now because it was going to happen eventually. And you know, let's get that over with now, and get some regulation in place. And you know, a lot of times I'm not a big fan of because we're heavily regulated. It's a pain in the neck. I don't like being regulated. I think some of it, you know, just a lot of times feels kind of ridiculous, but is so necessary because that's what provides confidence to investors and to us,
consumers,
to everybody.
There needs to be consumer confidence that if they put more money in some sort of exchange, it's not going to evaporate.
Yeah.
It's not going to go away. It's not going to end up in a real estate in the Bahamas.
Yeah, and one of the issues with regulation in the United States with regard to crypto and blockchain and so forth has to do with the way we regulate in the United States, which is a little bit different than how they do it in some other countries, like Singapore, for instance. The way our regulators work is they just kind of sit back and they wait for somebody to do something they don't like, and then they whack them. And they go, oh, you shouldn't have done that. I know that you didn't know you shouldn't do that, but now I'm telling you that you shouldn't have done that. And here's a massive fine and all this kind of stuff. And then everybody else from that standpoint goes, oh, okay. So we have a regulation in place right now.
There's the line.
There's the line. And that's how we do it here. I wish that, you know, what they could go through and, you know, just provide some guidelines right from the start.
Right. I'm kind of the opinion that a lot of the regulation has, these people have just stuck their head in the sands and I've not done anything. There hasn't been much any regulation. Mm-hmm. And it's because they don't know what to do and they don't know where to start. And it's people making these technologies happen, and the people making regulation decisions have no idea what's going on.
They don't know the technology.
Even this is crypto, but even if you take just a step back at technology, I remember, it was 2 years ago maybe when Zuckerberg went to the Hill and talking about how Facebook works with advertisers and stuff. They just had no idea how the technology works. And so you need to get good companies who invite regulation to some extent. You don't want them putting a moat around themselves. But they need to be part of the decision making of, hey, what's necessary here and where are the shortfalls and what are the loopholes? Getting those, and it goes back to what you just said, the way the regulation is done, it's probably not the most efficient. Yeah,
there are a few things to unpack there, so one of them is that I think back and learned this a long time ago, basically the Securities Acts that we operate under, they call them the 1930s Acts. I think it's the 1932 and 1933 Act. Jared could tell us, he's studying for this for a test tomorrow, right? That, Congress had no earthly idea what had just happened with regard to the stock market crashes that occurred. And they went to the industry, and basically the industry did write those rules for them. And what was interesting, they wrote in for themselves, we're not under FINRA, but those who sell securities are under a self-regulatory organization. That's what Congress did back then. They said, yeah, we have no idea what's going on. Y'all regulate yourselves because you know what's going on, which kind of sounded a little bit like a good old boy kind of thing, but it's actually worked for almost 100 years. Mm-hmm. So that would be an interesting thing if they kind of brought these folks in and kind of let them help figure it out.
Design some
advantages
policy.
And disadvantages to that. The other is you talked about Zuckerberg. I've just sat here, I've been just amazed at how there has been so little regulation just within, the I don't know what you call that, but social media. And the rise of these massive technology companies. They're not crypto, they're not blockchain, they're still what we call Web 2.0. And they still haven't been regulated really, in my opinion, to the level that they should have been.
I agree. And from looking at some financial reports, it seems some other companies who advertise on those platforms seem to think so as well. And customers who've taken their attention elsewhere, because it's been some pretty bleak earnings reports over Meta, Facebook, Meta now.
Yeah.
And so I don't know, maybe that's the way that people regulated it themselves. They regulated themselves off the platform, which
I kind of have regulated myself off the platform.
Right, I don't use it at all.
Yeah.
Now Instagram is owned by Facebook, I guess owned by Meta, and I do use that.
Yeah. But it's just, regulation just seems to be one or two steps behind. And I'd say both of these areas, which does lend risk to investors. There's no question. So it'd be nice to see some of that catch up and to where we could feel a little bit more comfortable about what's going on in these areas. No doubt.
Mm-hmm.
What else is going on? We got first of year is right here. This is when this is coming out. It's January. It's past the end of year. So I would say that you're kind of wrapping up your end of year stuff, making sure that you've made all of your appropriate contributions to the IRS as well as to your tax deferred accounts and things like that. Got a good idea as far as how your year is going to end up. You're doing budgeting for the new year. And January is traditionally a month. I don't know, most of the families that we work with spend the least amount of money in January than they do any other month out of the year.
Of recovering from the holiday spend.
Yeah,
all levels out, I guess.
Yeah, you kind of take it down a notch, and try to settle into something a little less spendy than what Christmas brings. So yeah, I would say that ending, kind of going through into 2023, we don't know what's going to happen with regard to the market or anything like that. All we know is that when you do long-term planning the way we do, you tend to make some really good decisions around your investments and your planning.
Right, not trying to guess what happens over the next 12, 18 months, because ultimately we're building long-term portfolios, and what happens over the next 12 to 18 months really doesn't matter.
Yeah, not at all. Yeah.
You want to build durable portfolios that can provide all the clients' needs, whether it's, if they're in income-producing mode, if they're in, let's put this money to work and have it grow for the next 15 years mode. All of those things can be taken care of when you have a properly designed portfolio, kind of with the 4 buckets we've talked about.
Yeah, no doubt. 2023 is upon us. Big year for you.
That's right. I guess St. Patty's Day, I'll be getting married. So.
That's right. That's a big one.
That's about as big as they come, I think.
Yeah.
Well, so far.
Yeah, so far, yeah. Well, that's really exciting.
It is. I am excited. And we're going down to Mexico. It should be a lot of fun. Good group of friends, family going down there. St. Patty's Day is kind of important to her and I. We met on St. Patty's Day.
Yep.
So it kind of worked out that we were able to do it. It's a Friday, so it works its well out, especially because it's going to destination. So Fridays, people can get down there and have fun in Mexico for the weekend.
Well, so St. Patty's Day always seems to be eventful for you because you met your future wife. You're getting married on St. Patty's Day. I also recall that you got COVID on St. Patty's Day.
Oh, that's right. That is right. Yeah, that was 2020. Yep.
Yeah.
It's been a travel weekend, I guess, because
always has
we
been
met in
for you.
Austin. The year after that was New Orleans, and then this year's going to be Mexico.
That's right.
And I'm sure I'm going to get reminded that we're going to have to do some more traveling on St. Patty's Day in the future.
I think that sounds about right. It's almost like a Chinese New Year for you.
That's right.
No, I'm looking forward to that. I'm looking forward to 2023. Obviously in our business, the market was down, so therefore, our clients' portfolios were down, which made it, a lot of work for us to make sure that we're communicating at a good level and, doing what we need to, the best that we can, given the circumstances. But yeah, we still grew.
Yeah, it's been
last
a
year.
super exciting year for growth on our front. And, we're laying out plans for 2023 and we're looking to, go bigger next year.
Yeah, we got this new office now,
That's
too.
right. We're in Las Colinas.
Yeah,
We're here today.
big digs.
It's a beautiful space. If you're in the area, want to come stop by, let us know.
Absolutely.
We'd love to show it. We'd love to show it to you.
Yeah. Yeah, well, cool. Well, thanks for pinch hitting today and coming on. Every once in a while, we just try to do this so you get a better feel for what's going on here at Schultz Wealth between Austin and I and what we're up to. Hope this helps. If you have any questions on anything, you can reach out to us at our emails, rob.schultz@schultzwealth.com or austin.smith@schultzwealth.com, or call us at, what's the main number these days? 405-4014?
817-405-4014.
Yeah, and give us a call. If you're not subscribed to this podcast, feel free to. We're on all the different systems and so forth, and just click through and subscribe. You can also subscribe to our bi-weekly newsletter that we do via an email. It's basically a podcast. So we alternate. We do it via video, and then the next week we try to write something beneficial for y'all. So plug in with us. We'd love to engage. And I think that wraps it up today.
We got lots of content that goes out.
We do.
Spend a lot of time on. We think it's important to kind of practice what we're preaching here. So
yeah, we try to provide some good stuff. So we're very good. Well, everybody have a great week, and we'll talk to y'all soon. Take care.